Hello, everybody. My name is Amalia Weber. I'm the program specialist here at Rochester Hills Public Library, and I'd like to welcome you to this evening's program, Millennials and Money, Setting Yourself Up for Success. Before we get started, I'd like to take care of a few housekeeping details. Firstly, tonight's program will be recorded and available to view about 1 week from tonight on our YouTube page and on the RHPL website shortly after. We ask that audience members please silence or turn off their cell phones before we begin in order to avoid any disturbances during the presentation. The Friends of the RHPL 8th Annual Wine, Wit, and Wisdom Fundraiser is taking place on Saturday, April 29th. The event takes place here at the library from 6 to 9:30 p.m. Audience members will attend 2 speaker presentations from a choice of 6. The evening also includes a buffet dinner, drinks, including wine, beer, and soft drinks, a silent auction, and a 50-50 raffle. Registration forms are available at the circulation desk, or you can visit rhpl.org/friends for more information. Our next program is Hiking Michigan Trails, which will be an in-person event on Tuesday, April 4th at 7 p.m. You can sign up for that at calendar.rhpl.org. And now, without further ado, please welcome our presenter, Stephanie Bloom.
Do I need this? Oh.
Yes,
Yeah. Oh, okay. Hi, everyone. Thank you for coming tonight. My name is Stephanie. If you're wondering, those are my parents who are sitting here. So my dad's also my boss, so hopefully he doesn't embarrass me. My mom, I guess, needed something to do tonight. So I was thinking, how embarrassing. Like, I'm a grown woman, and I got my parents in the audience. But it adds to the conversation, of course. I'm glad you're all here tonight. There are a lot of places you could be. It's a beautiful night, and the fact that you've made this a priority speaks a lot to who you are and what's important to you. So I hope you leave here tonight with a lot of great information. You feel energized and excited about how to take control of your financial future. You get your questions answered, and I hope to make this very interactive. So please stop me, interrupt me. If you came with a particular question on your mind, let's make sure that you leave with an answer for it. So this is me. I work with my family business. That's my dad, Ken. I brought him here actually because he's got a lot more experience than I do in this space. And to give him credit, he did set me up for success in a lot of ways when I was very young. I used to wait tables at a Coney in high school. And I remember I'd get my paycheck and my dad would say, okay, now you got to save something, right? You made $200. We're going to start saving for retirement. And I was like, I'm 15. Leave me alone. And I'm very grateful for the things that he did then, because now I've got kids. Life is a lot more expensive. And you got a lot of competing financial priorities when you're in your 30s than you did when you were 15 and, spending your money irresponsibly on things that were fun. So I'll pick on him to help chime in with his 40 plus years of wisdom. So I've typically done this presentation over Zoom. This is the first time I've actually done it in person, and I use a lot of polls. So maybe we can just raise hands so I know who's in the room if I didn't get a chance to meet you before. So which of the following best resonates with you? A, are you new to investing? B, I have some experience. Or C, I have lots of experience. So A, I'm new. My mom, she's new, okay? I have some experience, okay? And then I'm an expert. I'm here to test your knowledge. Okay, so most people say you have some experience. Maybe you have a 401k plan. Maybe you've dabbled in like GameStop or something that you saw on Reddit, and you're here to get some factual information. So what are we going to talk about today? So we're going to start off by talking about what makes us different than our parents. I think a lot of times our parents want to share advice and wisdom about all things parenting, how they did things better or different than we did. And our parents are different with money than we are. And I think it's important to understand that. So sometimes you can say like I got it from here. I don't really thank you for your advice, but no thank you. We'll talk about how to set yourself up for success, and we'll talk about some situations you are likely dealing with. I'll talk about the 4 main mistakes I see millennials make when they come to meet with us for an appointment. And then we'll answer questions. Cool? So who are we as millennials? Why are we different? Oh, I also should have mentioned, I'm sorry. So my day-to-day job, I work with the family. I'm a director of client engagement. Basically, I work to make sure our clients are happy and satisfied and well taken care of. I'm also a financial advisor. So every day I meet with clients like this. We're a team of about 20. We're located in Farmington Hills, and we just help everyday people, hardworking people who have made their money, help it grow and help them meet their financial goals. So with that, okay, why are we different from our parents? Come on in. You're not late. Well, first of all, we have delayed purchasing a home compared to our parents. We don't care as much about ownership. I think that's like the headline on here. We care more about access. We don't really care about owning a car as long as we have Uber or Lyft and we can get around. We're fine. We don't need a second vacation home as long as we can use Airbnb or VRBO and rent. We're fine. Our parents placed so much emphasis. The American dream to our parents and grandparents in many ways was owning a home, and that's just not the case for us. We've delayed marriage and parenthood in general, right? We're having fewer kids later in life. The good news is kids are really expensive, so we're able to put that off a little bit longer than our parents did. And then in marriage, and also, I think there's more millennials who are single at this age than at our parents' generation, right? There's like FOMO culture. I think that's all coming from social media, right? We're seeing what our friends are doing, what they're affording. You see what's going on, and you get this like, oh, I want to do that. And so you go and do that. Maybe it wasn't the financially sound or the best decision for you, but you go ahead and pursue these things because we have so much more access to what's going on around us. So those are sort of the highlights in my mind, as to what makes us different. The other big things is that we watched our parents go through financial downturns, right? We saw them and how they navigated 2008, 2009, and how it impacted your household, right? Maybe your family had to make some significant changes. We are, burdened with student debt, right? We've all gotten higher education. Like, show of hands, how many of you have a secondary degree of any kind, right? So a good chunk of us have a secondary degree. If you have debt, you're not alone, right? The majority of us do carry debt. And because of these things, we are very financially conservative. And this is very concerning when planning for your future, because if you're so financially conservative that you're risk averse or scared of investing, this could present problems for you down the line, right? So when I think of financially conservative, I often think about people who hold too much cash. And I'll talk about this as being the number one issue I see in millennials. So we've got 4 unique challenges, and I'm going to talk through each of these. So the first one is we hold too much cash. We're afraid to invest. We're financially conservative, like I said. So we're sitting on just tens, hundreds of thousands of dollars in cash. I'm thinking of multiple clients who I've met with, who they come to us and they say, Stephanie, I've got $200,000 in cash and I just don't know what to do with it. Like, should I just keep it in cash? Do I invest it? I'm scared. It's like, okay, let's talk through that, right? And why is holding cash a problem? Number 2, keeping 401ks with former employers. So unlike our parents, who probably had a career at 1 or 2 employers, millennials and the generations below us, we bop around, right? I mean, we work at one place, then we get an opportunity somewhere else, and that's a great opportunity for us. It looks good on a resume, whereas our parents' resume looked stronger if it showed commitment to one company. It's like when I look at a resume now, I'm like, oh, this person's worked at these 3 or 4 different places, and they've got a lot of experience. So that's a big problem. Number 3 is they're just waiting for the market to get better. Like, I've got this money, but I'm not going to do anything until things get better. And then number 4, they're looking for what's hot. They're like, oh, Bitcoin, NFTs, whatever it is, a get-rich-quick scheme. So do any of these resonate with you, of like issues that you're seeing? Okay. So by show of hands, number 1, anyone... Yeah, sitting on too much cash. Okay. Number 2, you have 401ks at former employers, maybe. Yep. 3, you're just waiting for things to get better. You're like, I don't want to do anything right now. And then 4, you're here for me to tell you to invest in GameStop or whatever else is hot. No? Mom? Okay. We're going to talk through all 4 of these. Any questions before I continue? Let me just take some water. I've gone too fast or anything yet? Amalia, anything? You're good back there? Okay. Don't want to forget you. Okay. So for any of you who said you hold too much cash, why? Why are you holding too much cash? You know it's too much. Why are you doing it? This is therapy. What was that? Just in case something happens. Okay, great. Having an emergency fund is really important. Okay, but it sounds like you're admitting that you maybe have too much for that just in case. Okay? Anything else? Right, you've got a short-term need. That's a good reason to hold cash, right? If you have a short-term need, you want to buy a house, you're expecting to buy a car. My kids, I've got 2 20-month-old twins, and this summer for childcare, I have to pay for camp, right? So I know I have that expense coming due, so I'm holding cash, right, to pay for it. Camp, in your case, it's a house. Anyone else holding too much cash for some reason? No? Often what I hear is like, I'm afraid. I'm not educated. I don't know what to do with it. I just don't know what to do. Or I'm scared. I don't want 2008, 2009 to happen again. So I'm going to talk through a good chunk of data. I'm a data person. So if anything is going too fast, stop me and I'll walk you through it again. So what this chart is showing you is savings accounts, what they used to pay on $100,000 if it was in the bank, right? So our parents back in their day, when we were growing up in the 90s and 2000s, and the black bar shows what that savings account, what $100,000 would generate in income. So if you look here, 2006, a savings account with $100,000 would have generated $4,500 in cash, right? So that's not terrible, just sitting in cash because you're waiting for your house or whatever. The blue line shows you where inflation was. So for most years in the 90s and 2000s, the savings account generated more income than inflation, right? So you were beating inflation. It was a good investment in some ways because it was covering inflation. Obviously, you can see the trend changed, right? So if you're holding cash, that cash is just losing money every day. It's a very risky investment for that reason, right? So we know that our dollar today costs, it doesn't go as far, right? A dozen eggs is like the great example, right? It was $3, now it's like $9 at Whole Foods or something crazy, right? So if you want your money to beat the rising cost, you gotta invest it in something, okay? I also love here, it shows you, this is for 2021, things are slightly different now, but the purple diamond shows you the income needed to beat medical care inflation. And then the triangle shows you income needed to beat education inflation. So we know the cost of living is going up, but also the cost of our medical care and our education is becoming more expensive. Any questions on this? Dad, did I miss anything?
No, other than to state that obviously this year, cash, if you hold it in a money market account, you can make probably 4%.
Yep.
What's interesting is this chart, which I use from JP Morgan. So if you have money in a Chase account, your bank in a Chase, you have $100,000 or $400,000, you are making 0.02%.
They're paying nothing on it at Chase.
So just keep that in mind.
Every bank will pay a different rate, yes.
What's the trend with income needed to beat education inflation?
So I don't have it here, but I could just say up. You know, I think these costs are just rising and rising. I think there is pressure and pushback from, our congressmen and women to change that, but I don't see that changing, unfortunately, unless there's some radical change to things.
And why is that? Why is that?
Why? Well, I think a part of it's because they can. I went to U of M. I don't know if anyone else is a Michigan grad here. I grew up a Spartan though, so if that helps. And hi there, come on, sit down. So I think there's just not enough pressure. I think every year public institutions are allowed to raise their costs. Their endowments are growing. U of M has an enormous endowment. What are they doing with it? Right? Are they using it to help defer student costs, Dad?
I don't know if the question was asked why interest rates at the bank are so.
Oh, I'm sorry. Oh, well, go ahead. You can answer it.
It's a very simple reason. The bank doesn't have any incentive to raise the interest rate. The bank,
They don't need the money.
they're sitting on so much money, they don't need to pay out greater rates of return.
They don't need the liquidity, right? They have it. That's why different banks will pay different amounts depending on how badly they want that cash available to them.
One last point on that. Stephanie and I met with this client today, hopefully client. They're sitting on $500,000 in cash at Chase, and they're making
0.01,
0.02%.
0.02. Crazy, right? Yeah, right? Unfair, but also like no more, do more, right? No more, do better, right? So we were telling this potential client, why don't we put it in a money market fund so you can at least make 4% or something, right? You keep it. You don't even have to invest it. Keep it as cash, right? But do better with it, right? So a lot of people say when I say, why are you sitting on cash? They say, I'm scared. Like, I don't want to lose my money, right? Now, we millennials we have the great benefit, the most important benefit of time. Warren Buffett said it's not timing the market, but time in the market, right? And we all have a long time horizon, right? I used to have a slide in here that said our life expectancy. For most of us, our life expectancy is well into our 80s. So we need to plan to live a long time, and we need this money to work for us for a long time. Well, this shows the U.S. stock market, and which direction is it going? Up. Exactly. So now there are certainly bumps along the road, right? It doesn't go straight up. And these red bars show where there was a recession of more than a year, and the gray show a recession that was less than a year. This goes until 2020. So it would show a little bit of volatility like that we're seeing right now with a little bit of a downturn. But people are always saying, I don't want my money to go down and another 2008, 2009 happen, or I don't want it to go down and there be a war, a global crisis, right? Well, look what still happened to the U.S. economy or the U.S. stock market when those things did happen, right? It does take time to recover, sure, but you are all long-term investors. Even my parents are long-term investors, and you have time for the recovery. Another one of my favorite sayings is the stock market is the only store that goes on sale that people run away from. Every other store, you go flying in, right? You cut the coupons, you get there, you look through the catalog to see what's available, who has the best deal, and you get it. Black Friday, I am there, right? Cyber Monday, you can find me. But the stock market right now is on sale, right? So March 2020, in 6 weeks, the market dropped over 30%. A lot of investors fled. They were getting their feet out the door. They were like, this is not for me. What did I tell clients to do, or my friends? I said, double down. This is a great discount, right? This is when you buy. And those who did buy were greatly rewarded, right? 2020 and 2021 had a beautiful rally. The market surged. Things were much better. Now we're having some bumps, right? But I'm very optimistic and hopeful that, and I, confident that things will again head north. Questions on this? Okay. Very similar slide. This one just shows you if you had $10,000 and you put it in the U.S. stock market in 1951 and you let it grow, that $10,000 would be worth over $23 million today. Sounds nice, right? The blue is every time it was a bull market. A bull market is when the market's going up, right? The orange is a bear market when it's going down. So as you can see, there's a lot more blue than orange. So when people tell me I'm sitting on too much cash because I'm afraid, I'm saying, okay, I know you're a little afraid that the market's going to go down. You might lose some money here or there, but over 75% of the time, the market is up. Okay? So any questions on the holding too much cash? Have I convinced you that if you have too much cash, not thinking about your emergency fund or, short-term needs, are we convinced that we should do something with the cash? Okay. I will point out, when I talk about emergency funds, we typically say you should have 3 to 6 months of cash available to you. Should you lose your job, something happen. I'm more of a risky person. I went skydiving once. I'm a riskier person. I like to gamble a little bit here and there. I do gamble very responsibly though. But 3 months to me is fine to hold. If you're someone who can't sleep at night, if you don't have 6 months, that's okay. You have to sleep at night. That's what's most important. So start with that. And then if you have beyond the 3 to 6 months, then it's time to come to terms that you're hoarding cash and it's time to get some help. Okay? All right. We talked about number 1. Number 2 is keeping 401ks with old employers. I saw a couple hands go up around this one. A lot of people are like, I don't know what to do with it, so I just kind of leave it there, right? I don't know what my options are. So I'll give you a story about a client of ours. She came to us and she had 4 different employer plans. She worked at Rocket Mortgage, Quicken for a long time. She was at Ford. Now she's at Home Depot. And she didn't know that she had options of what to do with it. She was receiving all these statements in the mail and her email was getting flooded. She didn't know what she's supposed to do. Some of them are trying to sell her different products. They are charging fees every month on these accounts. It might be nominal, might be like $10, $12, but still that's $10, $12 of your money that they're taking out of your account every month. There was no organization across all these different plans and duplication, right? So one of them would have U.S. stock market. Another one would also have U.S. stock market, and she didn't really know what was going on. And she wasn't really a risky investor. So she was potentially taking on more risk than she was comfortable with. So the solution for her was we took all these 4 401ks, or 3 because one was her current plan, and it's called a rollover. So if this applies to you, you want to roll it over to an IRA. What that does for you is it makes it accessible to you in one place. So instead of 3 or 4 plans being with 3 or 4 different providers, instead you're going to have them all at Fidelity. You can see all your money in one place and make one clear strategy. Okay? There's no cost to it. There's no tax consequences. It's pretty easy to do. You just have to make it happen. Any questions on that? I think you had said that you had a multiple, right? Okay. So, okay, good. We're waiting for the market to get better. That's number 3. We're just waiting because we're not sure. We're concerned things are going down. Are they just going to keep going down, 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 down? I've talked about this one a bit. Well, we're waiting for the market to get better. This is one of my favorite slides. What this shows you is from 1980 to 2020, the U.S. stock market again, okay? Now the bars show you, the blue bars show you where did the year return end for the U.S. stock market. So in 2020, the U.S. stock market ended up 29%, okay? In 2008, it ended the year down 48%, right? But it also, down 37%, okay? But it also shows you the green white bar. It shows you what was the one-day drop during that year, okay? So 2020 was a great year, ended up 29%, but there was the worst day, it was down 5%, okay? In, what was this? 2017, the year was down 3%, but the worst day was down 19%, right? And if you notice, every year has a bad day, right? A really bad day. So these drops and declines are really expected. It would be weird if they didn't happen, if the market just went up, 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 right? So if you're waiting because you're seeing that there's these bad days happening, you shouldn't be concerned. It's normal. We'd expect it. Any questions on this, Dad? 2021. That's right. 2020 was minus 34. Thanks, Dad.
Think about the chart is another reason why you don't want to time the market, because it's impossible to figure out. Every year, you can go back this chart another 40 years, but here's a chart for 40 plus years. Every single year, the market is negative at some point during the year. And they're 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, at least 18 times where it's down double digits for the year. But during that entire time, 75% of the time, roughly, it's positive for the year. It's remarkable.
Yeah. So there's some great research out there that shows that if you miss out on the best days in the market, what that does to your returns. Because there are really good days and really bad days within 1 year, right? So the best days in the stock market from 1993 to 2022, the best days, 52% of them were during a bear market. 26% were during the first 2 months of a bull market. So when the market is going up, and then 22% is during the rest of a bull market. So when the market is going up. So the majority of the best days in the market are actually when the market is doing its worst, right? Because a bear market is when the market's going down, right? Now, if you miss out on those days, so if you had $10,000 invested in the stock market from 1993 to 2022, you were fully invested every single day in the U.S. stock market. That $10,000 would now be worth $158,000. But if you just missed the 10 best days because you were like, I'm not ready, I'm going to sit it out, or I'm going to go to cash on those days, just missing 10 days, your return has, more than halved. So now you're down to 72. You miss 20 best days, you sit out for, a few weeks, you're down to 42,000. If you sit out a month, 30 days worth of the 30 best days, you've only gone from $10,000 to $26,000 in that time period. So when clients call us and they're nervous about the market and they're like, I want to go to cash, I'm scared, this isn't for me, we kind of sit them down and remind them that you got to, not only are you going to ride the downswing, but you have to be ready to ride the upswing. And if you miss those upside days, this is what it would do to your returns. Any questions there? It's just how the data, you could run this for any time period. A lot of the data, even if you go back here, this was a 40-year period, just how things are reported. It's not significant, but I'm confident if you went back, did it from 1983 to 2022, you'd have the same results. Did you have a question? It's not. So it just in general, how is the market doing, right? So if you ever see a headline like bulls and bears, or you think of like the picture of the New York Stock Exchange has a picture of a bull, right? It just terminology that's used. Bull, you think of a bull charging towards someone, right? So that's, the market's going up, it's charging ahead, and a bear is like scared and goes backwards and falls down. So it's the whole market. The whole market.
Your market generally defined as a drop of 20%. Okay, and a bull market is 20% from it's high. Okay, so last year we had a bear market.
20%.
When they say the market, generally speaking, like yes,
So S&P 500 is the 500 largest U.S. companies. IRA, that kind of stuff, those are types of accounts. And I'll talk about that. So you have accounts. Within accounts are investments, right? Within an account, you may have the S&P 500 index, right? So in your IRA, you may have that investment, right? So when we say bull market, bear market, it's talking about the overall S&P 500. How are the 500 largest companies doing? Any other questions here? No? Yes. Yep. We'll talk a bit about diversification too. Great point. So number 4 is you're looking for what's hot. I don't know about you, but like you're having dinner with your friends, you're at book club, whatever it is, and people are like, oh, I made so much money doing X, Y, or Z, or, my friend just bought an NFT of, I don't even know, and they've turned it twice and made this much money. Crypto, Bitcoin, Dogecoin. Did anyone get involved with crypto? No one bought crypto? I did buy a little bit of crypto back in like 2016, I think it was, when everyone was starting to talk about it. And I was like, I'm going to put a little bit in. And I wasn't in the business at the time. And my dad said, put as much in as you're willing to lose. So I put a very little bit in. And then as soon as it doubled, I pulled it out and that was it. So I really don't know a lot about crypto. And that's part of the reason why, we don't invest in it for our clients. It's very speculative. It's not well regulated. You really gotta know what you're doing to be involved in it. So we don't have that expertise. And we like to invest in products that we have more confidence in, and we don't have a lot of confidence in crypto. And the news recently has made us feel better about that guess. There's been a lot going on with Sam Bankman-Fried. I don't know if you saw there was another indictment or something against him I saw, and lots of scams and FTX. You just gotta be careful. If someone tries to convince you of a rich quick scheme, it's probably not gonna pan out for you. Okay, so I kind of walk you through all the issues I see, why we're different than generations before us. Let's talk about what do we do about it. Anyone here want to talk a little bit about debt? Would that be helpful? Debt, just at a high level. I'm a big fan of the avalanche method. This is different than like what Dave Ramsey talks about. I don't know if anyone follows him. He's like a financial pop star, I guess, whatever you want to call it. My feeling is pay off the stuff that's most expensive, right? So in this example here, you've got 3 different types of debt. You've got credit card, personal, and student loan debt. Different amounts, right? The largest is student loan, which is for most people what is the most debt they carry, but student loan debt is actually least expensive. So my advice would be first pay off your credit card debt and then your personal loan, and then pay off your student loan. And make a plan to get out of debt, because that's exhausting. We talked a bit about this already. Get invested, get that cash to work. $1 today is worth a lot less than it was when we were younger. I always talk about, I used to go to the movies. I remember it was $8.75 for a movie ticket when I was in high school. I don't know what it is now, $15, something like that. It's expensive. There you go, Tuesday nights. Gotta go. So instead of sitting here next week, you can all go to the movies. Time is your friend. We talked about this. The best day to start investing is today. Here's another hypothetical of $100,000, assuming you made 10% every year. Are you going to make 10% every year? No. This is just a hypothetical example. If one person starts immediately, the orange line, and that money grows for 10 years, $100,000 will be worth $259,000. If you're sitting on your hands and you're not doing anything and you waited 5 years, it would have grown to $161,000, right? So you made $61,000 here. That's a big difference, right? Time is your friend. Let's talk about accounts. There's a lot of acronyms in finance that can be very overwhelming. So maybe some of these words sound familiar to you. I know you have like an employer plan, like a 401k, something like that. So 401ks, any sort of retirement plan, if you work in a nonprofit space, maybe you have a 403b or like at a healthcare system or a university. These are employer-sponsored plans. You can contribute $22,500 each year to those plans, okay? Make a plan to like hit that goal. After you build up your retirement, your emergency savings fund, I think hitting this goal is a big goal and a great goal to have. A lot of employers give a match. Anyone's employers do a match? So it would be foolish for you to miss out on that. That is free money. Look at it as a raise, okay? They're rewarding you in some ways for saving for your future. So make sure you get that match. There are then IRAs, Roth IRAs, these are individual retirement accounts. Let me just explain them quickly to you. IRA, anyone have an IRA here? Okay. It's an individual retirement account. It's in your name, okay? This is money that you put in pre-tax, so you're not taxed on the money, and it lowers your taxable income, so it lowers what you pay in taxes, and when you take out the money after age 59 and a half, you're taxed on it. So in my hypothetical example, you made $100,000, you have a IRA that's worth $20,000, you're only taxed on $80,000, okay? So a Roth IRA, the money, instead of you paying tax on it later, you pay tax on it now. So you can put $6,500 into that account each year, same with the IRA, and it doesn't lower your taxes now, but in the future, you're not going to pay tax on it. Why is that a big benefit to us? Because this money's going to grow. It's going to appreciate, right? So I'd rather pay tax now, exactly, than later, because that $6,500, well, 30 years from now is going to be worth significantly more. Okay? There are some income restrictions, so you want to make sure that you look at it very closely. Yes? Yes.
So for Roth IRA, is there any like any study or anything that shows like up to this age, it's better to
It's a great question. Yeah.
after that age you should go like
It's a great question. We actually today met with a client and they asked the exact same question. It's really about your individual situation is the best I can tell you. So blanket advice I would tell millennials is you should absolutely put your money in a Roth IRA. That's not knowing anything about your personal situation. Because that money has time to grow tax-free, right? And so you would say, oh, why should someone in their 70s put money in a Roth IRA? My dad today in a meeting was sharing with a client how there was another client of ours who had a very large portfolio, and he was in his 80s, right? How old was he, Dad? 60s? Oh, 60s, okay. Late 60s. And he decided, one of the things that you can do is you can convert money that's an IRA, so it's pre-tax, and you can convert it to become a Roth IRA, so post-tax. And this client decided he wanted to convert $1 million from his IRA to his Roth. He's in his 60s. Why would he do that? Well, he's going to have to pay a lot of taxes. When he does that, he had to write a check for $400,000 to the government. Why would you do that? Well, he's doing it for his children because that account he wants his children to inherit, and he doesn't want his children to have to pay taxes on it when this is what, in this case, they're going to inherit it upon death. So it all depends on the individual situation. It's a really hard question to answer. You know, we talk a lot with clients about tax diversification with their money too, right? It's good to have some IRA money and Roth IRA money. There's different rules. IRA monies have required minimum distributions. It means you're required to take it out every year because the government wants you to take it out so you can pay taxes to them, right? Because otherwise you would just let it sit and grow. Roth IRAs don't have required minimum distributions, right? There's different things. So I'm sorry I can't give you a steadfast rule. 59 and a half. Yep. So by the time you hit retirement, that money is grown. There's no penalties. You can take it out, tax-free, smooth sailing. Yes. Yes. No, that's just you alone, what you can contribute. Good question. Anything else? Yes. So, are you saying if you already contributed 22,500 and you don't know what to do with the rest of it? Is that what you're saying? So these are just retirement accounts, right? So great question. So if you've hit your 6,500 and maybe even your 22,500, because you can do both of these things, then you can put your money in a brokerage account, right? A brokerage account is a non-retirement account. There's no tax incentives in the same ways, lowering your taxable income and such. This money is taxable. So earnings, when you sell your funds and such, you are paying big capital gains on these things. But that's a great place to put that money. That's the money you're saving for, something you want to do in your 40s, right? Things that you don't want to wait till you're 59 and a half to access. Yeah, Dad?
59 and a half is the age you can take out of this money from your IRA without paying a penalty. Generally, if you take it out prior to age 59 and a half, you have to pay tax
10% penalty.
penalty. So you get your money beforehand.
Correct.
And with IRAs, there is what's called a required minimum distribution. For people who are really old, like myself, that age is 73, then when you have to taking out the money. For you guys, it'll be 75. Then you just have to take the money out
Each year.
your life expectancy. Also,
Uh-huh. You're good. That's why I brought you.
The IRA is the only just about tax planning strategy that you can use now that relates back to last year. So you have
Good point.
April 18th of this year to make your 2022 IRA contribution. You make a traditional one, you get a deduction, or you make it into a Roth IRA. But you have till April 18th, usually April 15th.
But they allow you to kind of work backwards until tax day, essentially. So I think it's really important to understand your risk tolerance. Yes. Yeah. Correct. Correct. So for your, go ahead. You can, no, go ahead.
So it's 6,500. You're filing a joint return. And as long as joint income is $13,000, then you can make a contribution for each spouse of 6,500.
Yes. It has to be earned income. Yeah. So I think back to my days waiting tables at Coney, right? If I didn't have 6,500 in earnings, if my W-2 wages were only $3,000, I could only put $3,000 into an IRA. Yes. It's okay. So it's 6,500 combined that you can put in. Good question. Anything else? Would you have to refile, I guess?
If you're
An amended return.
traditional IRA, if you're making a Roth IRA,
It wouldn't matter.
it wouldn't change your tax.
Yeah. Right. Yeah. Otherwise, you have to file an amended return. No problem. So I think it's really important to understand what you're comfortable with all things. And we always tell our clients with investing, you should never do something that you're uncomfortable with. If someone's trying to talk you into something, that's the minute you should just walk away. You got to sleep at night. This is your hard-earned money. So you want to make sure that you're comfortable taking risk. So we ask client, we do a questionnaire, and we say, like, are you going to be okay, basically, if your portfolio lost 25%? Are you going to sleep? And some people say yes. I could sleep. Why? Because I know I don't need the money, right? I have a long time horizon. I have more experience and knowledge in investing. I can handle that. But some people are like, I can't handle that, right? I need more steady waters. And if you're someone like that, then you need to invest accordingly, okay? There are riskier investments than others, and you just need to make sure you're picking what's right for you, okay? A lot of people will say, oh, you're a millennial. You should have 80% of your portfolio in stocks. And I just don't believe that, because you're a millennial and you also have a lot of other things going on in your life, and anxiety and stress and maybe kids. And you don't need to be stressing about your money in that way, okay? So you had mentioned this before about diversification. Diversification is really important. I'll give a little example. If all your money was in Apple stock, you may have done really well at times, but then recently tech has done not well, right? Especially last year. If all your money would have just declined and all your eggs were dependent, the house that you were about to buy was dependent upon that Apple stock, you'd be in bad shape, right? Apple's one example, but imagine if all your money was, in crypto and with FTX and Sam Bankman-Fried, right? It'd be a nightmare. So you want to make sure that you diversify in a few ways. So the first way is asset classes. Asset classes are things like stocks and bonds, right? You've probably heard these words before. Stocks, it means ownership of a company. If you buy Apple stock, you're buying ownership in Apple. You're a little shareholder, right? You get a little certificate. You own a little bit of Apple. Bonds are actually buying debt of a company, okay? So you could buy debt for Rochester Hills, and Rochester Hills makes their payments because they collect tax revenue, and they'll pay you back on your bond. Now, by law, Apple has to pay its debt holders before its shareholders. So bonds are less risky. Okay, you're going to get paid back before the shareholders are going to get a dividend. Okay, so you want to make sure you diversify, and within asset classes, you want to have small companies, large companies. You want to diversify across across sectors. So industries, energy, financial services, tech, healthcare. Right? You wouldn't want to put everything in one place. Diversify globally. We live in a global economy, and I think things like the supply chain crises we've been seeing here and the shortages everywhere, just a reminder that what's happening in Asia and in Europe does impact us here in Michigan, right? So you need to have access to that. And all this to say is that investing is just not very sexy always, right? It's not cool and hot to talk about how you have a diversified portfolio and you've got all these stocks and bonds and mutual funds are what we use with our clients. It's a lot cooler to just pretend to talk about that you understand things like, these hot new investments, but this is sort of the tried and true strategy. I'm going to breeze through some of this stuff. Investing is like gardening is my best analogy. It's not a crock pot you can set and forget. It needs consistent pruning. You need to evaluate what funds you have in your portfolio. Are they right for you? You need to constantly rebalance, making sure that your risk tolerance matches what your portfolio shows. You may have a fund today that works for you and tomorrow it doesn't, right? So you want to make sure you're constantly looking at things to make sure it still works. So, any questions there? Questions been answered so far? Yes.
This is more of a general question, but how would you tell what you do?
So, if you determined that a portfolio that's 80% stocks and 20% bonds worked for you, hypothetically, that means it's a moderate risky portfolio, okay, pretty risky. Well, if the stock market starts going up, then all of a sudden, instead of your portfolio being 80% stocks, maybe it becomes 95% stocks, and it's only 5% bonds. So what does that mean you do? It means you sell the stocks, you sell the winners, and you buy bonds, the losers, to bring things back into balance. But then also, if you have an investment that's in a bunch of small banking companies across the country, maybe you decide that's not for you right now because you've seen money leaving these small banks and going to larger multinational businesses, right? So let me kind of, for the sake of time, I can talk about some of these things. You mentioned you're purchasing your first home. Here's some situations that we'll talk through. I think it's important when you think about what you can afford, don't just think about the mortgage. A home costs a lot more than just the mortgage. You've got insurance, taxes, maintenance, upkeep, unexpected. Shop around for interest rates, especially now. Things are negotiable. Anyone have kids here yet? Yep, okay, great, me too. 529 plans are what we usually suggest instead of MET plans. Are you familiar with either of those? We have some great information on our website that explains a lot of this stuff, so check that out. But 529 plans, go to misaves.com. You can do it in 5 minutes. Start with as little as $25. And then just, we'll answer questions from here, but I hope tonight was helpful. I hope that you leave here and you take action, and that you know some tangible things you can do, things you can look into, and how to set yourself up for success. Know what you don't know, If you need help, there are resources for you, and get a team of experts around you, an attorney, an accountant. We're financial professionals. If you're looking for a financial professional, make sure you're working with a fiduciary. This is someone that is legally bound to give you advice that's in your best interest. They're not selling you anything. There's no commissions. There's no trip to Hawaii if they put you in certain investments. And that exists in our industry. There's a lot of bad actors, and they give us a bad rep. So make sure you work with a fiduciary. And if you're interested in learning more about us, you can visit us at bloomadvisors.com. Lots of blogs, timely information. Our Facebook page, LinkedIn has stuff. And I also brought some resources. We usually give these to clients, but we have these checklists for like milestones when people are going through things. They're like, what am I supposed to do? So I brought one on changing jobs, like things you should do. Newlyweds, for anyone who's new. Is anyone a newlywed here? No? Okay. Or if you know someone, you can give it to them. Growing your family if you're having children, and hopefully no one here, but divorce in case anyone needs. So any questions that we didn't address? Are things on your mind? Yeah. Want to talk a bit more about that? Great question. Okay. 529 plans. Every state has a 529 plan for the most part. Michigan has a plan. You put money in. The money can be used at any university in Michigan, not in Michigan. It can be used for vocational programs, trade school, private school, secondary school, post-secondary degrees. It can be used for paying room and board, books, a lot of flexibility on them. I really like a 529 plan. That's what we have for my kids. Low cost. You can go in there and pick your investments. I just did it aggressive for my kids because they don't need the money for a long time, right? A MET is a Michigan trust. I wasn't sure if it was trust or something else. Essentially what you're doing is you're buying credits for tuition at today's cost, knowing that it's getting more expensive in the future, right? Now, if your child decides to go out of state, that money doesn't go as far, right? So they say, okay, tuition in Michigan, you paid for one tuition credit for the state of Michigan. Well, your child's going to school in New Jersey. It's worth 80% of that. If your child doesn't go to a university or a place that takes it, you've got a lot less flexibility. So I really like the 529 plan because it gives you a lot of flexibility. Dad?
There are a lot of other benefits of 529. The first is the money doesn't have to be used just for other things. Okay? So
Yep.
it can continue to grow for many, many, many years. If one child is very talented, gets a scholarship, money can be rolled over from one child to the other child. Okay, money. I know people who kids went through college. They're just letting the money sit there and just continue to grow. You can put in money for your grandkids. Okay, so the money can grow. The quote risk is you're not funding to a specific cost or need. It's not like saying, oh, I have tuition paid for. The MET just covers tuition. It does not cover room and board, does not cover any other fees. The 529 plan can be used for all fees going into. So the reason we like it, I like it, is I have much more flexibility, I have much more control, and I can use it for a lot more things. And in Michigan, by the way, so there's a lot of 529 plans. The reason Stephanie mentioned the Michigan plan is a small Michigan income tax deduction. And that is up to $10,000 per year, whether it's one account, or 10 accounts, or 15 accounts. You get a
4%.
you get a deduction up to $10,000 per year. So that basically saves you $400
Yeah.
in taxes. $425.
Yes. Yes. So it can be transferred to another child. If you have no other children, now they've announced that you can roll it over to a Roth IRA up to, is it 10,000 a year?
Do is, if you only have one child, okay, you let the money sit there, you let it continue to grow. The account's been open for 15 years, you're able to take out money every year and fund it for your child's Roth IRA. Okay, so right now the limit's $6,500, you'd be able to make a $6,500 contribution. Worst case scenario, you decide you want the money. Now you have to pay tax on all the earnings.
Which you would have had to do if it was in any other kind of account, but yes.
But I use it for school.
Yeah. Yeah. It's,
What I discovered is my children will never go to college, so.
yeah, I mean, you could use it for yourself. You could use it for yourself too, yeah.
So, or you can hold on to it, and your kids have kids, you transfer it to your grandchildren. So it keeps on growing and growing.
Yes. Correct. Yep. Continuing education courses, right. It's very flexible. I mean, I'm pretty sure you could probably end up using it if you want to take culinary classes, you know, I mean,
But I guess it has to be university or college.
no,
Can be also
I believe it has to be here in the U.S. I believe so, yes.
Part in that thinking, and at the time I was thinking, well, maybe we should. But you know, if you choose, both spouses choose to work, and if you are frugal the rest of your life, you do your own home projects, and you listen to the right economists, Charles Payne, Larry Kudlow, Stephen Morris, learn as much as you can about economics. Because what's happening right now, what I'm seeing, I've been to South America, I've studied South America. This administration is following a plan that took place in South America with inflation.
But I think politics aside, I think there's like a lot. It's okay. No, it's okay. I think there's a lot that like you can take action from, hopefully from today. And the 529 plan, it potentially sounds like great solutions for both of you, especially because you have a lot of flexibility.
By the way, according to Google,
Take it for what it is.
study abroad expenses such as tuition and fees, room and board, are eligible funded,
That's study abroad. Study abroad, but is that like you're a U.S. student studying abroad, or it might be something like that? Yeah. So I would have to look into it a bit more. I've never been asked that before.
you have to be an university.
No, you need a social security number to open an account. So, other questions? Yes.
What would you recommend someone do if like their income, let's say, falls?
Great question. Great question.
I have some old retirement stuff
Mm-hmm.
going on right now, but like
So I think I would. do the best that you can. Hopefully you have some sort of emergency fund to not touch that money. Your future self will thank you if you can find a way to not touch your retirement funds, especially because you're charged, penalties and fees for pulling it out before, age 59 and a half. You definitely shouldn't leave that money sitting in cash if you have another emergency fund, so that money should be invested in a diversified portfolio. So that my advice would be the same. My hope is that you've got an emergency reserve. If you're not working, you're not contributing to your portfolio. So in some ways that's saving you money, right? It's because you're not, potentially $20,500 isn't going towards your 401k, or $6,500 isn't going to your annual Roth. So I think about your expenses. Do your best to cut where you can. Even cutting subscriptions like Netflix and Hulu can add up. You think about over the cost of a year. So do what you can to tighten your belt a little bit until you find something. And but I would still keep things invested. Hopefully you're not planning long-term unemployment, and so this is hopefully just a hiccup, which speaks to the importance of having an emergency fund. Obviously you can't build it while you're unemployed, but yes.
Always recommend with the IRA to exhaust this, putting, like say you have 6,500, that's all you can invest in here. Do you say put all of it in that?
I think it depends on the individual person, right? So if you're someone who is trying to buy a house, that is a financial priority of yours right now, and you need that money for a down payment, then that wouldn't make sense for you, right? But if you have no short-term needs for the money, you have an emergency fund, the next place that I would think about that would make sense is retirement. And so does that mean doing it through your employer? Does that mean doing it through an IRA? And then after that, I would start thinking about things like 529 plans and whatnot, because, there are loans available for kids, to go to college. 529 plan is a gift. But there's no loans, if you're in retirement, you don't have money, that's a different kind of problem. Yeah.
So, even though when you're a millennial, in your 30s, and you look at people who are in their 60s and 70s, and it's just ancient, it's such a long way away. And the one thing that I heard from my parents, I heard from their parents, and they're really true, everything happens in an instant, okay? And, I look at her, and obviously we're very proud.
Aren't you glad I brought my parents tonight?
But when we look at her, we look at her, and she's a toddler, okay? And I'm telling you, it really is true in an instant. So when there's a tendency for a lot of people to say, I'll put it off, I'll put it off, I'll put it off. And then all of a sudden they're in their mid-50s and 60s, see it all the time, and they've not done anything.
And across professions, we've met with doctors before who come and they sit down and they say, I haven't started saving for retirement, and they're in their 50s.
So I happen to be a big proponent of not necessarily doing too much. I wanted to set up a plan that has a high degree of success. And so if you say, look, I have 6,500 and I have some, I got to build an emergency reserve. That's really a high priority. Build it. But maybe instead of putting all 6,500 immediately there, you put 4,000 in there. You take some to your retirement. Okay, so you don't.
It's balance, right?
I guess I should have maybe
Yeah.
and we're supposed to be getting a pension, so we're not going to be having a 401k.
But you still need,
The way I'm understanding.
Well,
So
so
I'm thinking that if I would have had like 6,500, just put that half for like IRAs and half for
a pension, in all likelihood, I mean, pensions today are less generous than they were.
exactly.
So I would still say you need to build up retirement savings outside of your pension. Well, you could save for retirement technically through like a brokerage account, but there's no tax incentive for you to do so, right? Whereas a Roth IRA or a traditional IRA have some benefits, right? Either you get the tax deduction now or you don't pay taxes in the future. So that seems like the better decision.
And it's like all kind of hypothetical right now, because I don't
Right.
have a pension working right now, so I don't get to even know how it works.
Right.
So that's why I'm like here
Yeah.
ahead of that
Yep. Totally. Yes.
while you're here.
Yes, of course. Yes.
I think the biggest thing my dad told me
Mm-hmm.
You need to put the money away for retirement.
Yep.
And you have time.
That's right. You've got time. Yes. Yes. So you,
If a 401k.
it's through your employer,
So if they don't have one, you can't.
but there are other retirement plans like an IRA. Right.
And so I have an IRA and I have a Roth IRA.
Yep. Great. Keep it up. Yeah. Yes. Great question. Great question. So we charge a percentage of the money that we manage. So, if depending on how much money that someone brings to us, we charge a fixed percent. Typically, it's around 1%. So it all depends, though, based upon the size of the portfolio. We bill quarterly. No long-term contract. The worst thing ever is when you join a gym and then you try to leave the gym and they basically require a kidney to get out of it. There's no kidney in our business. If someone's not happy with our services, we're obviously disappointed, but they can leave immediately. There's no hidden fees. We really believe in transparency, and that's how we work. That is a great question. One of our slogans is that you don't have to be a millionaire to get $1 million advice. Typically, we have a lower minimum than most. It's still, for millennials, sometimes a hard hurdle. Our typical minimum is $250,000. It's not a little bit of money, but that's sort of where we start. If you're below the threshold, I think there's lots of things you can do to start, without hiring a professional. But when you start getting above that 250, that's when, I think it's the right time to seek professional advice regarding taxes and lots of other things. The one thing I didn't touch on tonight, and my dad would yell at me later if I didn't, especially for those of you who have children, please make sure you have an estate plan. If something should, God forbid, happen to you, what happens to your children? At Bloom Advisors, we have a law firm, Bloom and Associates. It's our sister company, and we do a lot of estate planning for clients. But you don't want, a court to decide who gets your children. So please think about that. Correct. Yeah, something that makes us unique actually is we manage 401ks for our clients. A lot of companies don't do that. So if you work for Ford or whatever it is, we log in and we make changes to your portfolio, and yeah, so we take care of the 401k stuff, which is good.
What I should say, if anyone is interested,
Of course.
sit down and talk.
Absolutely. We're a family business. It's kind of embarrassing that they came, but don't judge me. I was like, gosh, I feel like it's like I'm getting a star of the day at school or something. But yeah, you probably have a picture of that too, Dad. But I think our employees have been with us since I was in diapers. It's a nice team, and there's around 20 of us. And my dad and my uncle started the business almost 40 years ago, and it's a great honor that I have to join it. So. Any other questions? Yes. Please. Yes. Fine. So, rate, yes. Yep. Welcome. Where are you coming from? Oh, welcome. Yeah, I have a good name I can give you of someone I trust, and you can get a quote and see who gives you a better cost. There's a lot of fees. If you look at that one-pager sheet, a lot of them are negotiable. The mortgage industry right now is struggling because rates are high, right? So it's becoming more expensive to buy a house, right? Your money's not going as far, so they should be competitive with you. They should give you a good cost.
I mean, right now, the only thing that we have for this person is that he shared a pre-approval.
You don't know anything. Don't worry.
I mean, we have no idea what's in there. I mean, there are no interest rates.
Yeah, that's just so you can go and look at a house and you can show the real estate agent that we qualify. Because what they don't want is someone who doesn't have a lot of money going to look at a $5 million house and wasting their time. So you just need that letter to say, oh, yeah, open the door for us. We're qualified to look around, but you don't owe him or her your business at all.
What happens is mortgage, a lot of people, who, the majority of them are mortgage brokers. They're not the one lending, but they're looking to find you a lender.
Yes.
Okay, if you went to Chase, they're loaning you their money. But for the most part, people are looking for their brokers, okay? Now, if you do contact stuff, she'll give you the names. Okay, you make no money whether
Yeah.
you use them.
That gets back to that fiduciary. You always want to, we don't get a commission if I give you a name or something. It's just someone who I trust who has done well for other clients of ours. So you can look at them, talk to them.
No, but I was just going to say, what you really want is someone who is going to cut out all the bullshit, because there's a lot of bullshit, okay? And just to make things easier, tell you, okay, you know, mortgage rates are X, Y, or Z, you can qualify for, you know, A, B, or C, here's the whole process, okay? That's all. And then you want someone who can deliver when the time comes. Because a lot of these people that are out there, they, you know, get ready and they're looking for someone, they really can't deliver, and now you're screwed because you're trying to, you know, close on a house and you can't get funding on the mortgage.
Yeah, that could be one. And the other thing is that the moment you get here, you know, the other Mexican community here, like they have their own concept for everything, right? So
Right.
if you don't know if outside that community, you can find some other good deal.
Right. And so I wouldn't know if that deal was a good deal by any means, but I can at least give you a name of something that we do, because we don't sell mortgages, we don't sell insurance. If a client does need a mortgage or does need insurance, we say, okay, let's go get some quotes, and we analyze them and say which one makes the most sense.
She's going to give you the same person, pretty sure, that I referred her to when she got her mortgage.
Oh, I was going to also give them another name. I was going to give them that name and Zach Stern. Yeah, he's taking care of a few clients for us. Yes. No to stretch. Okay. Anything else?
So, since traditional IRA and Roth IRA and 401k are different, should they give like different investments?
So what we like to think about, it's a great question. What we like to think about is your money is all one big pie, right? So let's say you have $1 million, okay? And you know that like a 60-40 portfolio, 60% stocks, 40% bonds works for you, right? It's moderate risk. We want to think about where do we get that 60-40 from? And sometimes it makes sense on a tax perspective. So for tax reasons, if it's something that's going to generate a lot of capital gains, so a lot of taxes, we maybe want that in a retirement account so that you're not going to be taxed on it in your in your 1099s annually, right? So there's a whole strategy around it, which in fact is why we tell our clients no portfolio looks exactly the same. Collectively, it will be 60-40, but individually, they look very different. So great question. Think about risk overall. Your accounts should not be identical. They should look different. Anything else? I hope this was helpful. Please take some of these resources. I hope maybe they'll help you or help someone you know. I do have my business cards if you have any questions, but I do appreciate you guys coming tonight.